All right, I'm here with Scott Inman with Gen Wealth Financial Advisors. Scott, thank you so much for being here today.
It's my pleasure to be with you, Alicia.
All right, well, we know that the markets right now are down pretty big, between 25 and 30% for the year. So a lot of that has happened this month. Can you talk a little bit about what's going on right now in the markets?
Yeah, well, I think, first of all, there's no question that our response to the coronavirus is going to cause and is already beginning to cause a massive economic disruption. We know the businesses are closing, they're losing revenue. We know that people are not earning income in many cases, and so that's going to affect consumer spending. So I think what's happening in the market here, and I think it's important to understand the difference between an institutional investor and a retail investor. Institutional investors are big groups, organizations, corporations themselves, in fact, and they're really trying to speculate right now. How bad is this going to get, let's say, 6 months down the road? Or when it's over, how bad is it going to eventually get? And they don't know the answer to that. So what they've really, if you read economists right now, a lot of them are believing they're pricing in deeper cuts than we may actually have. So if you think about that in layman's terms, they're trying to reach a worst case scenario that we may not reach. So we're still looking for the bottom. I think we're close to it, but that's why you see these up and down swings. I mean, we're obviously more down than we are up, but like today, we're having an up day in the market because maybe they feel like things have gotten too low. But it's going to be a roller coaster ride while we are enduring this crisis. There's no question about it.
What should investors do about this, and specifically those at home?
Yeah, so I think the first thing, I think about what Governor Hutchinson has said many times about panic buying at the grocery store. Well, we don't want panic buying at the grocery store, and from my perspective in the market, we don't want panic selling. And I think that's the worst thing an investor can do right now is sell because they see things are going down. We are in a bear market. That means that we are more than 20% off our stock market highs. Okay, so that does mean that we are in a down time and we could likely be ending up in a recession. But if you look historically, Alicia, over the course of a bear market, how long does it take to recover? All of the bear markets in recent memory have taken on average about 20 months to recover. So I think the question that investors should ask themselves is if 2 or 3 years from now they truly believe we're going to be down and not be higher, then that might cause them to make some moves. But I don't think many people would answer that question. If you think rationally about it, historically we're going to probably be higher than we are now and possibly even above where we were in 3 to 5 years from now. And if you are invested in the stock market, you should have a long-term time horizon in mind. And 3 to 5 years is certainly not what we consider a long-term time horizon. So in a short term, relatively, we could be back. And you don't want to get out and sell when things are going down and then have things go back up before you get back in.
Now, on the flip side of that, there are some people going online right now looking at these extremely low share prices. Is now the time to get in?
I think it is if you have cash on the sidelines. I wouldn't get out of something else and move things around. I want people to know, again, with that long-term investment time horizon in mind, to stay invested. But if you do have some cash on the sidelines that's just sitting in a savings account and it doesn't deplete that savings account, it is investable, we would say, I think that it is a good time to look at some opportunities because we do have an opportunity to buy low. And I would also say that also means in your 401k. Don't stop contributing. If you are contributing on a systematic basis, and that money's going in, you're going to naturally catch some of these dips over the next couple of months.
Yeah, and I'm glad you mentioned that because wrapping up here, so many people are looking at their 401ks and going, oh my gosh,
yeah,
what on earth is happening? Can you just touch on that?
Well, that's the thing I would tell them not to do. I think I told you when we were talking before we started recording that I look at my clients' accounts every day except for one client, and that's me. I don't look at my own account statements because I am emotionally invested in that, and to stay emotionally detached, the best thing you can do is not look at your statement right now. I think that you have to keep contributing in your 401k. Don't stop contributing and don't panic sell because you see the market going down. I think the bottom line is we've been through this before. And in 2008, the most recent example of such an extreme down time. But if you sold in 2008, and didn't get back in. The market lows were early 2009, and until we hit this rough patch, we were up over 300%. So think about that. Get out now, and then 10 years later, we've more than tripled the value of the stock market.
All right, Scott Inman with Gen Wealth Financial Advisors for us. Thank you so much for the great information.
My pleasure.